Hello and welcome to Switzer TV Property. I'm Peter Switzer, and on this week's show we go looking for the good value buys in this very hot property market. Tom Panos of the Real Estate Gym says look for units. Then Destiny.com.au's Margaret Lomas looks at the 4 property buying mistakes you have to avoid to end up not being in the poorhouse. And property lenders Paul Myliotis and Paul Miron of Msquared Capital tells us what is really going on for borrowers that can't win over the banks. This is a lesson on the reality of real estate for non-normal borrowers. So without any further ado, let's kick off with Tom Panos. Well, the housing market is on fire, and one guy who's used to seeing plenty of fire in the housing market is Tom Panos. Now, Tom, you tell us, you're from so many areas. I always knew you as an important consultant to the REA Group, but tell us, what your real role is nowadays.
So I've been working for News Corp for about 20 years. Most of the time now it's as a consultant, and I commentate on the market for them, and I do that via their media outlets. But I also spend a lot of time in educating the real estate industry with a portal, the Real Estate Gym. So I've got around 30,000 opt-ins in that membership side. So I'm very, very close to the behaviours of what buyers and sellers are doing in short periods of time, Peter. So yeah, real estate it is with News Corp and realestate.com.
And on Saturdays, you're an auctioneer, aren't you?
Correct. So I run an auction business, and I do about 10 myself. Others are outsourced to other people, and it's hotting up. This is last Saturday I had a few on. This Saturday there's even more on, but we're moving into the hot auction season as we speak across Sydney, Melbourne, and Brisbane. Okay. Now I
introduced you. I said this is a very hot property market. How hot is it?
It's very hot, Peter, but it's not hot in everything. It's hot in houses, no question about it. It's hot in regional Australia. It's hot in first home buyers. It's hot in prestige markets where you've got all these expats that are coming back. They're trying to get on a flight with a carrier, and they're coming back with a lot of money. These expats, they were on $500,000 to $1 million a year. They've got cash. So all those markets are affected. But let me tell you, unit markets are not hot. Units are not selling. In fact, they're going down, generally speaking.
All right. Now, when I'm doing my stock market show, I often talk about Warren Buffett, and he says, be greedy when everyone's fearful and be fearful when everyone's greedy. So is this a buying opportunity in the unit market for the long-term player?
It is. And if Peter, I think when you buy real estate, you look at it a little bit as a marriage. You don't buy real estate because, think about getting married. I better get married quickly because I'm running out of partners. And then you end up marrying someone you don't want to marry because, you thought they're all going to run out. And that's a case that happens sometimes in real estate. Now, in respect to units, at the moment, you're in a good spot if you're a buyer because you're buying and there's a lot of stock on the market that's not being sold. So you've got plenty of choices. So I think that it is a buying opportunity, particularly, Peter, when the vaccine gets rolled out. And by the way, you're the only person that I spoke to during the last year or so that said earlier on, the vaccine is coming. Don't panic. And in fact, that's eventuated now, and it's factored into the way the markets are operating. But if you're a buyer right now, you can buy a unit at a discounted price than say a year or 2 years ago, and know that when the vaccine comes, you're going to get the behavior of people saying, hey, it's safe to be in an apartment building again. Because one of the causes of units losing a bit of popularity in this market is, Peter, people got concerned that they were going to have what happened in New York with high-rise buildings and people wanted space. That's going to change. And also regional Australia might change, Peter. I mean, there's a big exodus of people that have gone to regional Australia, and that's booming. But if you look at what happened in the 1920s, when people with the Spanish flu, people left, And then when they realized, hey, we're not going to die, we can actually get on with their lives, they came back to the cities again. They're urban dwellers. Humans want to be with other people.
Yeah. So in a sense, what you're saying then, provided you're prepared to take a longer term view, there could be some really good buying out there. But here's my follow-up question then. Imagine I say, right, look, I'm a property investor and I know units are a good value at the moment. If I buy a good unit, what's the likelihood I can find a tenant to actually pay me rent?
You're going to find a tenant, but you're going to have to factor in a 10 to 15% discount on the rent.
Yeah.
Because there's no ifs or buts about it. Vacancy rates are higher and rental discounts are the biggest they've been in many, many years. And the reason why that is, Peter, is first home buyers who are traditionally the person that was once a tenant are now buying. It's cheaper to buy. With the rates that we have, it's cheaper to buy. So you're going to have to discount your rental. But hey, here's the deal. You get 500 instead of 600, right? For a year. Yeah. Work that out. That's going to cost you $5,000, right? $5,000 in, rental losses. Well, I've got to tell you, if you buy something at $100,000 discounted, $5,000 is insignificant when you look at the fact that you're buying at a discounted purchase price.
Yeah, and I guess the bottom line also is make sure you buy a property that tenants want to live in, close to either the transport facilities, the beaches, all those sort of places. They're the places where you're likely to find a tenant rather than probably some areas that are less attractive.
The better the tenant, the better the property, the better the rental income, the better your life as a landlord. So, Peter, I think not a bad idea is to say, hey, would I put my kids in here? Would I put them in there? If it passes the family test, you're going to be inclined to appeal to the masses in the rental market.
All right, now, if you're a potential buyer and you're finding you're missing out at auctions all the time, and you must see a lot of disappointed faces at the moment, do you say, look, eventually APRA is going to come along and make it harder for people to get loans and prices will start falling again? Or do you bite the bullet and pay more?
Peter, if I knew the answer to that question, I probably would be spending 8 hours a day out there buying and selling real estate, knowing that I'm going to, forecast on what's going to happen. So it's very difficult, to turn around and be very conclusive with that. But I will say this, mid-February to end of March, you're going to have a small window buying opportunity. And the reason I say it is, this is the time when vendors saturate the market. So you're going to have a supply of more stock than other times in the year. Peter, everyone wants to try and get their property sold during that, Australia Day and Easter period. Yeah. So there is going to be stock on there. So I would suggest if you're a buyer, take advantage of more listings in the market mid-Feb to sort of end of March, just before the Good Friday. To your second question, APRA, interest rates, having the market sort of change because it's too hot. I don't know about that. And the reason is that there's still a couple of factors there that, who knows, Peter, if the media starts writing stories, hey, JobKeeper ends in March, hey, holidays on mortgages are over, that could potentially just sort of soften it up a little bit, soften it up a little bit, right? Yeah. So I would be taking advantage of that period there. But if you're if you're a buyer that's buying a home to live in, hey, don't make a decision based on the market. Make a decision based on your life. Don't go off and buy a home and say, hey, we're really happy we bought this home because it was a really, really good buy. Oh, unfortunately, we're going to have to drive the kids to school an hour each way each day, right? That's not a great decision because you end up selling it sooner than what you want because you can't cope with the new lifestyle and you're up for stamp duty and legal fees and agents' commissions. So pick the property based on your lifestyle first before on the market. If you're an investor, it's a different kettle of fish.
Last question, mate. You have seen the newspaper report saying that house prices are possibly going to rise 30% over the next 3 years. What was your reaction when you heard that?
I think, Peter, that's quite possible. And, you know, if I'm a investor in the marketplace, when I look at the fact that there's been a year that prices actually went down for 15%, and if you're saying to me that, oh, they're going to go up roughly 10% a year, that's what you're sort of saying, 30% in 3 years, I've got to say, that's nothing glamorous. I mean, realistically, it's pretty good. But if you amortize that over 5 years and you factor in a couple of years that it didn't go up and a year that it went down, I think 10% should be something that is quite possible, and anyone in property would hope so. But look, there are parts of Australia that aren't going to get 30% growth. There's some mining towns, Peter, you know what they're like. They have periods where they go off. You know, you look at some of the areas like Gladstone, right?
Yeah.
All areas. Yes, correct. They don't all perform brilliantly all the time. But I think Sydney, I think metropolitan areas, that is quite possible. 30% in 3 years, absolutely.
Tom Panos, thanks for your insights.
Thanks a lot, Peter.
Well, at a time when we're hearing that the house prices of Australia are booming and are apparently set to boom for at least 3 more years, that's the claim from even the Reserve Bank of Australia, but it doesn't mean it's going to be right. I want to talk to Margaret Lomas and to make sure that people actually, if they're going to become property investors, they do it right. And one thing I've found is that for our financial planning clients here, we often get people who have never looked after before coming in with a batch of silly properties that they've bought, been recommended by, I think, financial planners who haven't got a clue. And I want to make sure that the people watching this learn how to do property investment properly, and Margaret Lomas is the right person to do it. Thanks for joining us, Margaret.
Thanks for having me.
All right, Margaret, you would see it as well. I'm sure you come people who try to do it themselves even, or have been advised by other people, even spruikers at conferences and whatever. What do people need to know about investing in property successfully?
You know, I always find it very interesting that when people want to invest anywhere, they're very happy to consult with a financial advisor when it comes to their share portfolios and their managed funds. And then when it comes to their taxation, they'll go to an accountant. But when it comes to property, for some reason, they feel that they're qualified to make a decision on what's best for their financial future just because it's property. I think the very physical nature of property gives people a false sense of security. And a lot of people think that, you know, we're all born in property, we're all raised in property, and many people think this gives them an edge or the ability to assess whether or not a particular property is right for them. And I guess the most critical thing that people need to understand when it comes to property is, in exactly the same way that not every share is going to do well, not every property is going to do well either. There is no such thing as a property market. The property market doesn't go up and down with regularity. It doesn't do it with any uniformity either. So some areas could be growing while others aren't. And not all property grows. You know, I often hear the spruikers saying property doubles every 10 years. In fact, my son is looking to buy a property at the moment, and I was with him at an inspection where the real estate agent said directly to him, property doubles every 10 years. And, you know, I can point to hundreds of examples of property that hasn't even doubled in 20 years and hasn't even gone up in 10 years. So there are so many things that people need to understand about property, and they need to get more serious about it and treat it as the investment that it is, rather than that thing that I buy because it's the next step in my retirement planning.
Yeah, and some people actually buy property because they want to get the tax deductions, and they don't think about the capital growth implications. They don't think about whether they're going to have a tenant in there all the time. And these are the sort of things that you would make sure the people you advise that they get right.
Yeah, look, it always worries me when someone's accountant has told them that they've paid too much tax and they need to buy a property, and then next moment they own a property on a golf course estate somewhere in some random suburb in God knows where, because it's come with fabulous tax deductions. And then they're very disappointed when 10 years later the property is probably worth considerably less than they paid for it. They don't have much of a secondary market. Just when they need the money because they need to sell down for whatever reason, they have difficulty getting out, and the property sits on the market for 527 days, and then they take a low price and realise that all they got out of it along the way was a bit of a tax deduction that might have reduced their tax by a little bit, but nowhere near enough to compensate them for the big loss that they have on selling that property at the end of the day.
Yep.
So the thing about a good tax deduction is it might reduce your tax, but only insofar as it gives you back some of your tax to help you pay the expenses on that property, to maybe hold it a little longer. But those tax deductions don't do anything for capital growth, and they certainly don't guarantee you'll get capital growth.
Yep.
And very often, the bigger the deduction, the more likely that that property is probably situated somewhere where we're not going to see big growth in the first place.
Yeah, but I do know that over time, if you've got a client who picks a really good property and all that sort of stuff, the tax benefits can make it easier to own a really good property. And you also recommend the use of quantity surveyors as well. In the past you have anyway, that actually help you maximise your legitimate tax deductions.
100%. And there's certainly tax deductions that are an advantage and make them often a little more advantageous in the eyes of the investor than perhaps having a share portfolio. And they're often used, those deductions are often used in the debates that property people will have against share people in what makes it a better investment. But I really want people to understand that, first of all, tax deductions are the icing on the cake and should never be the driving force behind how you choose property. But secondly, there should never be a debate about whether shares or property are different or better. They're just different and more appropriate for where you are in life, or different stages in your life. So there are people who might come to me and want to buy property as an investment. And for whatever reason, after examining their financial circumstances, property may not be the right thing for them. They could be closer to retirement. They may not have a lot of money in superannuation. And therefore, buying a property with 5 years to retirement is unlikely to get you the outcome that you need for that day you retire. If, on the other hand, you're 5 years from retirement and you have significant super, then it could be that by the time you retire, you can take up that super and live off that while the property sits there and has that opportunity to perform. And you might not need that property to provide benefits to you until you're maybe 10 or 15 years into retirement. So I guess what I'm getting at, Pete, is that one of the most important things about buying property as an investor and learning how to become a good investor, and I've got probably 4 good points to make, but the first one is that it has to be financially suitable for where you are on your investment time horizon. And that also governs what you choose as an investment. Some investments may have a very negative cash flow, but a good opportunity for short-term growth. Other properties might have a very good cash flow, but a longer-term opportunity for short-term growth. And it doesn't take a genius to work out that each of those properties is going to suit someone at a different stage in their investing time horizon. A young person just getting into property has a long time to wait for that capital growth. And in the short term, they're probably on lower wages. They might be still having a great time in life. They might not have as much personal cash flow available. And getting that cash flow to cover the costs on the property becomes critical. Someone who is an older person, closer to retirement, who probably has the kids already left home, their personal cash flows may have improved and they might have more money. They might be at the top of their career and earning bigger incomes. They can afford to support those short-term negative cash flows in favour of getting that growth sooner. Having said all of that, that particular formula isn't necessarily precise or exact for all property. Some properties give really good cash flow and grow quickly, and some properties give bad cash flow and never grow. And this is where learning what makes property grow becomes critical if you're going to be an investor.
Yeah, and the point you're also making is for different sorts of people, different sorts of investments might work. but you can't just give one cookie cutter recommendation. This is what you do. And I guess it also underlines the point that sometimes you do need an expert who's trustworthy and not pushing a particular product to say to you, this is what suits you, not this.
Yeah, exactly. And that probably brings me to my second point, which is to not only be aware that the spruikers are definitely still out there, and whenever property's running hot, they get more prevalent, but that there are different kinds of spruikers. There are the ones that are easy to spot, and then there are the ones that are a little harder to spot. And while I agree that you need the right people on your team, you know, you'll always have a financial advisor for your share investments unless you think you can be a good share investor. I know I'm not, and I need a financial advisor for my share investing. You'll always have an accountant for your tax because he's the one who's going to get, you know, the best return for you on your tax. You always need a property person to help you buy the right kind of property, because unless you're in the game, you aren't an expert. But there are a couple of rules around how you choose. The first one is to be aware of the obvious spruiker. Now, the obvious spruiker is still the guy who has the big seminar, which is free, invite you to that seminar, and he often has financial advisors, unfortunately, linked to him, where he's offered them a big commission on any property sales, and that financial advisor will recommend to their client that they go along to this free seminar. But the thing about the free seminar is it might be free, but there's always going to be a hook there, and a lot of people are a little powerless to avoid those hooks. The hook could be that this fabulous investment, which they're obviously going to make it look great in the seminar, only has 10 spots available, or this big workshop where you learn how to become a better investor and learn those secret things that only these spruikers appear to know, which costs you 15 or 20,000 to attend, only has 5 spots available, or if you sign up on the night, you get it for half price. And those seminars will always have a 24-hour money-back guarantee. 24 hours after you get into that seminar, you're not happy, you get your money back. But often if you come to the end of it, if you're still not happy, then it's too late for that. So they've got some real strategies. And unfortunately, you might think you can go along to these and you be really, you know, you'll be the stone statue and you won't fall prey to them. But you just do when you get there, because the offers often sound too good to be true. And I've seen some really horrendous strategies offered at those particular seminars, ones that often take advantage of hapless homeowners who have fallen into dire financial straits, and the attendees at these seminars are taught how to take advantage of them. So that's the obvious spruiker. But, you know, there are also property advisors who might seem legitimate to you, who really aren't doing the best thing for the client. And taking up from your point about, you know, all property's not right for all people, there are very many people who call themselves property investment advisors or buyer's agents, but in reality, their stock is limited to whatever they're sourcing from a particular developer or two. That developer is giving them kickbacks that you'll never know about because they don't have to be disclosed to you by law. You may or may not pay the buyer's agent or advisor money on top of that. And what you're doing is you're being sold into an investment that nobody's assessed whether or not it suits your financial circumstances, risk profile, and time horizon. So you need to be very aware that those people exist, and there are a considerable amount of them in the industry.
Yeah, that's 2. What's your third point then?
So my next point is that if you're going to buy property as an investment, and you know, I think it's a great idea. I've obviously put together a big property portfolio of my own. I'm much better at that than I am at anything else. So my property portfolio has done better for me than anything else. Although, you know, I'm a big proponent of super as well. I do believe that people underestimate the benefits of super and the value of super to them in their later years. I think that's unfortunate. And I wish we had more people out there really, really pushing how important super is, rather than talking about how you can get 10,000 out when you need it because of COVID, or you can, you know, take money out. I knew someone who took money out of their super to have cosmetic surgery done because she was able to say that she had a psychological disorder that only cosmetic surgery could fix. I just wish there were more people explaining explaining how valuable super can be when you finally get to it and how important it is. But, you know, that's another show.
Yeah.
So you need to become literate about property. And to be literate, that means it's not whether or not it should have a tin roof or a tile roof or be brick veneer or any of those things, but where you're buying it in the first place. You shouldn't even be thinking about what you're buying until you've established where you're buying. And you can only know where you're buying when you know what drives growth, because cash flow is important. I've always said that. But growth overall is critical as well. There's no point in going through the exercise, which is a risky one, unless you are going to get growth at the end. So you need to know what drives growth. And the big things are a population growing faster than the national average, a diversity of industry in the area itself, or where it's a suburb of a city, the ability for people to easily get to where they're going to work. And that the work options have to be diverse, not just one industry. And obviously economic vibrancy in the area. And it's easy to tell whether a town or a region or a city is economically vibrant or not. But finally, the one that most people miss, I believe, is that family demographic. And it is families that make areas grow. If it's an aging population, we don't get as much money spent in the community. If it's a younger population, we tend to find they're very itinerant and we don't see a lot of businesses being started. If it's a family demographic, you think about it, people don't want to move around while their kids are in school. They don't like their kids to be going to different schools all the time. So if you've got 2 kids or 3 kids, you've got a 15 to 20 year window of schooling, which means you're going to stay in an area for 20 years. And if that area also has all of those other things I talked about, it's going to become in demand. People aren't going to sell. Property supply is going to be limited and demand will increase. And that's when we start to see growth.
Yeah, and that's one of the reasons why you liked areas north of Brisbane where there was a railway line being built, a university was going in, and the whole thing was like the perfect storm of great things to help property prices.
Yeah, and look, I think the problem becomes, Pete, that people are looking to get into those areas. People are always trying to second guess the market. They're looking to get into those areas that are going to have a sudden boom just after they buy. And if you can continually do that time and time again, good on you. And if you are prepared to include all of the high costs of buying, selling and capital gains tax in that, because you've got to make a pretty good short-term gain to make that flipping strategy work well every time. And you've got to have a bit of a master stroke, in my opinion. I mean, I like to think I'm a bit of an expert in property, but I've chosen areas that haven't performed the way I thought they were going to perform. And so to do it right every time and to really make good money out of flipping, I think it's a risky game and one that not a lot of people can make happen. And most people don't have the time for that. Let's be honest.
Okay.
We're buying property when we're trying to build a life and have a career. We don't have time to be that hands-on in buying that property and managing the portfolio and working out when to sell. And most people don't sell at the right time anyway because they just want to hang on for that bit more. You see it happen all the time with people who are buying shares. They just want to hang on for that bit more growth and then they miss that selling window. And it's easier to miss a selling window with property because it can take a while to sell.
Yeah.
So the important thing to understand is that you've got to get into an area. First of all, you've got to have a timeline of 10 to 15 years as a minimum. Don't think about short-term timeframes. But secondly, you need to be able to buy into those areas that will give you a good return most years out of that 10 to 15 years. I always use Adelaide as an example because I know people think Adelaide just plods along, and it does. But if you take a 20-year window of Adelaide and compare it to a 20-year window of Sydney and Melbourne, there's actually not a big difference between how the overall growth has been if you take into account the highs and lows of Sydney and Melbourne and the fact that Adelaide just keeps going up every year by a little bit, and a little bit. And there are plenty of areas around the country like that. So those family demographics in areas that you're talking about, like in the northern suburbs of Brisbane, you know, there's so much happening there to support that growth of families in the area. We're already looking at reduced land supply. We're getting more and more schools, and with the big university, and we're seeing medical centres and doctors' offices, hospitals being built up around that way. We're seeing so much happening all at once there, and many years of infrastructure to come, that there's no reason why it would be a bad area to invest in. So it's either going to be a pretty good or a very good place to buy. And the beauty of that area is that the cash flows are very good too. So it doesn't cost you much to sit in an area like that and just wait until that whole growth is developed out.
Okay, the final point, the fourth point.
The final point is one that I think you'll like, and that is to consider your risk profile before buying property. And it always stuns me that people just buy property because they think it's a good idea, and they have a notion that because they're using equity in their own home that they've got nothing on the line. You know, if you've got $200,000 in your hand in cash, I reckon that you'd be pretty careful about where you invested that $200,000. You'd want to be getting advice from the best financial advisors with the greatest reviews and the best performance background. You'd want them to be investing your money into something that's pretty secure but has a good opportunity for short and long-term gains. And yet, when it comes to property, because many people are using that equity in their own home, they're not thinking about the fact that they borrowed $500,000. They have $500,000 on the line here, and although they got it from the bank, it's still their responsibility. And so what they often do is they'll think, well, you know, I've lived here for X amount of time. This is going to be a great investment because I like it, and therefore they invest there. But in reality, they could live in an area that has an investment that carries greater risk and therefore wouldn't be right for them. So risk is all about buying the property that's appropriate for your own personal cash flows and, again, your time till retirement. Some properties are riskier than others. The example I gave at the beginning of the interview was the golf course estate, which is a very risky investment, or an investment in an area that is driven by tourism. Well, we all know now after COVID has hit that that's a very risky investment, and the risk can come from somewhere that you don't even expect or cannot anticipate. If you then talk about a 3-bedroom house in an area with families and lots of schools and some good employment, maybe in that sort of not cheap market, but certainly not $1 million market, then that carries a lot less risk because they're always in demand from tenants, they're always in demand from buyers, and you've got first home buyers in that mix to boost up the demand, then that sort of thing has less risk. So understand your risk, and risk relates to how much money you're prepared to lose. And that is the kind of property that you should be buying. You have to understand every property has a different risk rating. And my books actually show those risk ratings of the different property types as well.
Okay, great summary, Margaret. And I never ever let you go without asking you a question like this. What's your favourite suburb now or area for property investing?
Well, I think I'm going to shock you at the moment.
Shock me then.
Because I'm going to shock you because I've talked about the northern suburbs of Brisbane, and of course, just because I have a new favourite doesn't mean that they're knocked off the perch by any means. Yeah. But I'm liking Ellenbrook in Perth at the moment because we have an extreme undersupply of rentals there, with rents going up fairly quickly. You know, we had a client who we helped to buy a property over there just recently. And once it's settled, he got $50 a week more than had been anticipated. It's a closing window, but certainly as the heat returns to the Perth market, it's areas like Ellenbrook, which is a real family area, that is going to be getting most of the interest. And while I'm on that subject, there's an old fave of mine up there by the name of Balga. And I guess it's a little like, Sydney's Mount Druitt and how well that suburb did contrary to expectations. Balga is Perth's Mount Druitt. I think that there's some good buying to be had there, big changing demographic, certainly plenty of opportunity.
Well, once upon a time, Paddington in Sydney was urban blight. No one wanted to live in Paddington in the bad old days, and suburbs can change, can't they?
And Balmain, another good example.
Yeah, exactly. Margaret Lomas from destiny.com.au, thanks for joining us.
Thank you. And Pete, just before you go, if I've actually got 20 of my books, the 20 Must Ask Questions, to give to your viewers. The first 20, I guess, that email you and you can forward them on to me. I'd be happy to provide those.
Great. And we'll put an address on the screen for people to go to. Great stuff. Thanks for joining us.
Thank you.
From time to time, I like to talk to Paul Myliotis and Paul Miron from Msquared Capital, because these guys are actually operating at the coalface of the property market. And so I want to go and see what they're seeing, and that will probably give us some real insights to what's going on in what is described as being a very hot market. Great to see you guys.
Thank you, Peter.
Thank you. All right, so before we start talking about that, we probably should just, in a nutshell, explain what you guys do. So, Paul, what is Msquared Capital?
So we're a private mortgage fund.
Yeah.
We match basically borrowing opportunities where people borrow money with investors who want to have a stable return on their capital.
Yeah. So Paul, gives a classic example of how you guys actually do your stuff.
In terms of, look, Peter, a borrower will come to us and have a need for finance.
What kind of borrower is it?
Look, the borrower is always for commercial purpose.
Yeah.
So a borrower would come to us with a need for finance. They, for argument's sake, would have a commercial building that they would need to raise some money against.
Right.
They'd come to us, they would request money, we would then do our credit proposal, put it up to our investors who have money that want a return for their money.
Yeah.
And effectively our investors share in the interest that's received for that borrower, and that's how they get their return.
Yeah, and what kind of capital do they have to put up? What kind of collateral do they have to put up to make sure you can get your money back? Look,
we take residential security, commercial and industrial property. We are predominantly Sydney-based lenders. So look, we've found it great in this market because Sydney's been so resilient, and we tend to skew to the residential side because we've seen there's a bit of risk when you're lending against commercial assets, particularly because of COVID.
So if someone has maybe like a $10 million house, for simple numbers, what would the most they could borrow?
Oh, look, depending on the house, but look, we would shy away from going anything over 65%.
So they might get 6.5 mil if the project's good and the house is an easy sell.
That's right.
Okay, right, we get the idea now.
Yeah.
All right, so one thing we're hearing about is that the regions are doing really well.
That's right.
So what are you guys seeing in the regions?
Well, look, I think you've the recent data in relation to how quickly prices are going up in regional areas are quite astounding. I think last month CoreLogic said it's 1.6%. So we are seeing the largest exodus of internal migration from Sydney and Melbourne going to regional areas because of COVID-19, because they can buy a house for much cheaper, lifestyle purposes. They don't have to go into the offices regularly. So from our perspective, if you are looking to buy a house, and there was a old saying, whether you're buying a house, your own house shouldn't be considered as an investment property. If you're buying your own house, it's your own house. But investors should be a little bit careful from our perspective, and us as fund managers, we're very careful or cautious of lending money against regional areas.
Okay, so therefore, you guys have been here in the past. East Coast was particularly important.
Yep.
Sydney and Melbourne over Brisbane, but you will go to Brisbane if it's a very good deal, I guess. Yeah.
Look,
but regions,
and
is it because in regions it's sometimes hard to actually do a sale and get rid of a property if there's any problem?
I'll go through the logic why regional areas has a lot of volatility in it. See, where you have Sydney and Melbourne and Brisbane, people are centricated to certain areas, to convenience schools, things such as that. If you're going into a regional area and there's a boom in that area, there's unlimited land that you could unlock overnight. Developers start building, and you go from high demand, low supply to high supply. And then if that trend that we saw, this short-term trend that people want to go into regional areas right now, turns around because people are needed to go back into the city and back into the office, that could overturn very quickly.
That's a very important point. If people are buying in the regions hoping for capital gain based on what they've seen recently, but that's based on a constant supply. As that supply changes, that potential capital gain could go off the board.
That's right.
Okay, great point. Let's go to the next area. You guys are big in the commercial industrial space. People come to you because they might have difficulty getting money from banks because they're doing a business type borrowing. So what are you seeing there?
Look, we're seeing a lot of, in the recent past, we've seen a lot of inquiry on all three aspects of that asset class. From our perspective, we think, residential is where we would skew a lot of our investments. We see the residential market, whether it's houses or units, you can argue which one's a better class. We are very happy to take those securities. We think the risk of properties going significantly down in value, particularly in where we're looking in the Eastern Seaboard, is unlikely. When you're looking at commercial, the government stimulus is stopping. We can see cracks in certain tenancies with commercial property values. They are based on tenancies. So when we're lending and we see a commercial tenant, we have to look really strongly at the tenancy. So we are very, very cautious. Not saying we wouldn't lend against a commercial or an industrial property, but I think you should be a lot more cautious when you're doing so.
Have you lent to somebody who's bought a commercial property and because of coronavirus, they're not quite as a strong borrower because of that?
Yeah, absolutely, it happens. But it's very interesting to note, and we're watching this very, very carefully. So for example, the inner city apartments, I think the stats came in today, the vacancy rate has actually doubled. Talking to the agents, the values haven't fallen. So is that a sign what's going to happen in the future or not? Same thing with residential property, and I'll go through it a little bit more detail later, but with residential property as well, a lot of investment properties are vacant at the moment in certain pockets of Sydney as well, but the prices haven't fallen as yet. So
is that because a lot of the investors are waiting this out, thinking that, okay, it's not great, I'm not getting Airbnb overseas people, I'm not getting foreign students, but in a year's time I will. So rather than maybe taking a 10 or 15% loss on the purchase price, I'll wait a year.
Well, they're not taking a hit on the price. One of two things are happening. Interest rates are very low, so that's cushioning that shock. Second of all, there's a bank moratorium at the moment. So even if if you call up your bank and you say, look, I don't have a tenant, they can't take any legal action against you. So I think all those elements together has actually provided a very low supply of that, low supply onto the market. So therefore there isn't a downward pressure on it. But not to say, as a fund manager and for us to take security over these assets, I'm going to be a bit more cautious. Because even though if I read the headlines of the newspaper and RBA saying that the house prices could go up by 30% over the next 3 years, I need to look at worst case scenario because the whole system in relation to lending money is to make sure that I preserve your capital.
Industrial's doing well, I presume?
Industrial doing exceptionally well. And the reason why industrial land is doing so well is because obviously there's a demand for that sector, people buying online, but there's not enough land as well. So, if you look at it from a planning perspective, there's only X amount of industrial land across Sydney and Melbourne and Brisbane in certain areas. There's lack of it.
Well, a lot of people watching this program would be interested in your take about houses versus units. You've touched on it already. And I think the question that they're thinking is there really good value out there for people to start looking at home units because of, two things. People moving out of the city, office blocks are relatively empty compared to where they were. What's the take?
Look, CoreLogic, once again, I follow them because they have really good data as well. The difference between the gap between houses and units have never been wider at the moment.
In price growth we're talking about?
Not price growth, it's a difference in value. So the median, the value has not been wider.
So the median price of a home in Sydney compared to a median price of an apartment Biggest gap ever.
It's going, and that trend will probably continue.
But has the gap been created because
houses gone up?
Gone up, and units have stayed
and units have gone down marginally.
Yeah.
I think 0.2%.
So on a relative basis, then, Paul, units are attractive.
They will be. We think that units will catch up to houses, but it might take a bit of time. We believe that when the borders open, people will come into Sydney, or they'll come into the centres, and they're going to rise. So to your point, is it a good time to buy? You'd be arguing there will be buys out there. Rates are low, and we do believe it will catch up and it will follow, but it might take some time.
Well, as Warren Buffett said, and you guys know it, when everyone's greedy, be fearful. When everyone's fearful, be greedy.
Yeah.
That's right. But it's remarkable to see how prices of units hasn't fallen. The same way of the other analogy I gave you with commercial. In the midst of, there's less than, overnight we lost 550,000 people in Sydney who needed those dwellings. Yeah. So, you know, you had the students, the tourists, all those people have left overnight, and we haven't had net migration as well. So units do really well when net migration will come back.
Correct me if I'm wrong, and I know you will, because you always love to try and find fault with me. To date, you never have. Never. But when you guys started in this business, were you worried about the calibre of the apartment buildings, the blocks that were being built then compared to now?
The quality? Absolutely.
Yeah.
Like unfortunately, we've inherited probably a negative philosophy in relation to building as many dog boxes as quickly as possible. And the consequence of it now is that without the students, they're predominantly empty.
Yeah. And a lot of buyers, I guess, are a bit suspicious of new builds. And I know I've had people on my program saying, well, they're better off even looking at 30-year-old buildings. Yeah. They've stood the test of time.
The red bricks.
Yeah, that's right. And you can actually see if there's any potential danger or problem there. But these bigger ones are probably spooking a lot of younger people.
Yeah, and they probably are. But I believe that there's a very significant demand for larger apartments that don't exist. They haven't been built yet. In mostly in Sydney. Brisbane is a different market. They do have some larger apartments traditionally in their planning, but Sydney, in most of the areas, people have not traditionally tried to build a 2-bedroom apartment larger than 85 square metres.
I noticed, and you guys would know the area well, Rosebery, where a lot of apartments have been built in recent times. A lot of those seem pretty big, and I guess they are people who would like to have a home in the eastern suburbs, a house, but they can't get it, so they think, well, let's get a big apartment, everything's walking distance to golf and parks and beaches and stuff like that. But that's the kind of apartment that you think would have capital gain over time?
It should have capital gain over time because the demand for it will increase as things get normal after COVID. So there's a typical type of tenant that will be requiring that type of dwelling, and we just don't have them around at the moment. So I think it will normalise once COVID finishes, but there's still opportunity in the market. You know, for example, in Bondi, who would have thought Bondi, blue chip suburbs, if you have older unrenovated apartments, I've heard from property managers they've been vacant for 6 months. And even if you're
owned by investors, and they're usually rented out for the enormous crowd that goes in our Airbnb style, I guess. Yeah,
and look, even if they're dropping it at $100, $200 a week, less, let's call it 10-15%, they're still not getting enough interest. So that is a remarkable situation. But as I said, even more remarkable, the price haven't gone down on those assets.
The borrower perspective, you know, is there really a good deal flow going on right now?
Look, we are. We're seeing a lot, and there's two reasons that we've analysed why. When the banks are analysing borrowers, they're looking at for PAYG borrowers, I think that are buying residential property. That's the banks are doing well with delivering that.
It's an easy borrower.
When they are coming to the business operators that may have been affected by COVID. The banks typically like historical data. When they look at the data of what happened in COVID, when people have had a bit of a downturn, I think to get their head around how the business is trading now has caused an inflow of borrowers to us.
Yeah. So CBD business, you know, obviously had a bad run for a year.
Well, that's one, but just say, for example, we've had a borrower come to us that said, look, I did get affected significantly during COVID, but now I'm trading better than I did at COVID. I went to the bank, it took them 4 months to assess my deal, and they couldn't see the way I was trading. The way we assess deals is slightly different. We forensically look at their accounts, we forensically look what hits there. So we can verify what they're making now, historically what they're made, and we're talking clients with properties in Manly, in blue chip.
So they're very good collateral.
Very good collateral.
And usually their business would have been made it easy to borrow, but because of coronavirus,
there's been a
bit of a dip, and now they're going.
So,
and they can't prove to the bank that it's gone up, because the banks are quite conservative. They want 12 months worth of trading.
Yeah.
Now we've only come out of lockdown 4 or 5 months, so we took a different opinion. We said, okay, well, give me your current bank statements, and we do an assessment basically on what's going on in the last 2 or 3 months. A deviation from what the bank can do. They have good security. We look at the character of the individual. We want to see at the worst time when things actually dipped, how do they behave? They keep paying their mortgages and obligations. They did everything they could. So they sold assets. They did everything they could. So we look at the character of the individual. We look at the assets. We look at the situation, and so we can be a bit more flexible, and we can be a lot quicker as well. We finance it for a 12-month term. If the business goes back to normal, then they can go back to the bank in 12 months, no issue at all. So those are the type of opportunities that we're seeing right now. They're quite unique, and investors are still getting a very good return. So on that particular opportunity, it's above 7% net return to the investor.
And so the borrower was paying about what?
The borrower was paying about 9 on that particular situation.
And what if they could have got through to the bank, and the bank would have said yes, what would the bank charge them?
A bank would charge them 3s. So it's a significant premium for them not to sell all their assets, not to pay stamp duty, not to,
I think one important point there, Peter, as well, historically, the one, I know the deal that Paul's got in his mind, historically this is a bankable client. It's not like, sometimes there's a misconception that you go into a mortgage fund and some of them might be doing it, are in high risk. This is a bankable client. You're looking at a security that's based in the middle of, within 20k radius of the city. There's trading businesses turning over, let's use high level, $5 million. You're not talking someone that is in arrears, and that's right.
It's not a startup. It's not a startup business.
So, and that's why you said, probably within a year he'll be able to go to the bank and renegotiate.
That's right.
And
so we're there for a period of time.
We want him to go. That's the whole purpose. We want to raise the capital. We want to fix the problem that he has right now.
And he must have a very good business opportunity to be willing to pay 9%. To make sure it happens.
That's
Absolutely.
right.
Yeah. And so at the moment, in his field or other business operators as well, look, some of the competitors are not doing as tough as what he is, and he has an opportunity to take a bit more market share. So for him, he goes, okay, it's opportunity cost. It's going to cost a little bit more money in finance, but I can actually solve that problem without thinking about it. I can just focus on my business and grow it.
Okay, guys. If people want to know more about your business, what's the website?
www.msqcapital.com.au. But Peter, on that view, anyone that's listening can call us directly. We have no issue with people calling us directly.
Well, that's the show for this week. Thanks for joining us. In case you didn't know, I have a financial planning business called Switzer Advisory. And if you ever need any help trying to build your wealth, contact us on switzeradvisory.com.au, or you can call 1300 Switzer. Thanks for joining us. See you next week.